Do you want to pay less taxes? Great. Step 1, be a rich person. Did you know that the top 1% of earners use deductions and loopholes to legally reduce their tax rates to as low as 8%? Meanwhile, the average middle class worker pay over 20%. How is that possible? How do the wealthy operate within the same tax system that most of us follow yet play an entirely different game? It's word of rich, where the wealth is not just earned but strategically protected from the government's grasp. This is not some secret society meeting in dimly light room. It's happening out using rules designed into the system. And the deeper you go, the more jaw-dropping it becomes. Let's start with the Jeff Bezos, one of the richest people on the earth. In 2011, despite being a billionaire then, Bezos reported negative income and claimed a $4,000 child tax credit. Yes, a billionaire, negative income, child tax credit. How? His wealth was not tied up in a traditional paycheck, it was stored in Amazon stock, which he had not solved. No sale means no taxable income. It's a loophole so big you could fly a private jet through it. The trick? The rich don't rely on income the way most people do. Ordinary people earn money, get taxed on it, and spend what's left. The wealthy, however, borrow against their assets, stocks, real estate, or businesses. A billionaire might go to a bank, put up $100 million in a stock as collateral, and take out a $10 million loan. Loans are not income, loans are not taxed, yet that borrowed money is spent as well as cash from a paycheck. But wait, it gets better. Real estate is another playground for ultra wealthy. Picture this: you own a massive apartment complex worth of $50 million. Thanks to depreciation, you can claim that the building is losing value every year, even though the property is likely appreciating in the market value. That loss lowers your taxable income. And here comes the Section 1031 of United States Internal Revenue Code, where you sell one property and immediately reinvest in another without paying a capital gains taxes. And you have essentially postponed paying taxes indefinitely. The rich call this strategy swipe till you drop. And if you think they stop there, think again. Let's talk about trusts. Trusts are likely a financial time capsules. A wealthy individual might place a $10 million in a trust for their children. Over time, that money grows. But thanks to the clever estate planning, much of it avoids estate taxes. Some trusts even let you dictate how the money is used for generations, ensuring the wealth stays within the family. Now, let's bring up another name, Warren Buffett. He has famously said that he pays a lower tax rate than his secretary. Why? Because most of his income is from the capital gains, profit made by selling investments. These gains are taxed at a lower rate than regular income. While someone earning a salary might be taxed at 24%, Buffett's billion are often taxed at 20%. And then there are charitable donations. Don't be fooled by the name. Sure, some billionaires are genuinely altruistic, but charity can also be a tax strategy. For example, you own a stock worth of $10 million that you bought for $2 million years ago. If you sell, you will owe tax on the $8 million profit. But if you donate that stock to a charitable foundation, often one you control, you get tax deductions for $10 million. The charity keeps the stock, you avoid the capital gains taxes, and you still get to influence how that money is spent. It does not stop at US border. Either the wealthy are global citizens and their money moves just as freely. Offshore accounts in countries like the Cayman Islands or Switzerland offer not just a privacy but often tax advantages. And for multinational corporations, the game is even more complex. Ever heard the double Irish with a Dutch sandwich? It sounds like a pub snack, but it's actually a tax strategy used by companies like Google and Apple to shift profits to low tax jurisdictions. But here's where the story takes a twist. These strategies are not just legal, they are encouraged. Why? Because governments want to incentivize behavior that stimulate the economy. They want people to invest, to start businesses, to build housing, to give to charity. Tax laws are not written for the average person, they are often to guide the actions to those with the power to shape the economies. The problem is that while the rich play by these rules, everyone else is stuck on the sidelines. The system rewards to those who know how to play it. It's not just about having money, it's about understanding the game. And the rules are so complex that only the wealthiest can afford the accountants, lawyers, and advisors who decode them. But let's pause for a moment. Does this make a wealthy evil geniuses, or are they simply taking advantages of what's available? After all, if the rules are legal, is it wrong to follow them? Or is the real issue with the system itself? As mind blowing as these strategies are, they are not exclusive to billionaires. Many of these methods, like maximizing retirement accounts, reinvesting in real estate, or starting a business, are accessible to anyone willing to learn. The difference is scale. While you might claim a $5,000 tax deduction, they are claiming millions. So the next time you hear about the billionaire paying little to no taxes, remember this. It's not magic, it's a math, and it's the law, and it's the game where knowledge is power. But the question remains, should the rules change? Should the wealthy pay more, or is system working as intended? That's a debate for another day. For now, the playbook is out there. The only question is, will you use it?